Hello, and welcome to the latest episode of the Integrity365 Financial Insights Podcast. In these sessions, we're going to be sharing some thoughts and insights into the current events of the financial world to give you some things to consider within your own financial planning and with your investments. You can follow along with this series on our website, on YouTube, and on streaming platforms. Today, we're going to be talking about all the changes that have happened in 2024 and what this really means for us. Hosting today's podcast is myself, Sophie Haslehurst. I'm a chartered financial planner specialising in tax efficient investments, and I'm lucky enough to be joined by Oliver Jones from Rathbones. Hi, Oliver.
Hi, Sophie. Thank you for having me. Just for the audience sake, I am head of asset allocation at Rathbones.
And that sounds amazing, Oliver. What does that actually mean with regards to sort of what people might understand from that job title?
So I am part of a research team of about 50 people, but the asset allocation team in particular, we spend most of our time looking at what's going on in the global economy and really feeding into the top down, choosing between asset classes.
So you have to really understand everything that's going on and try and not predict the future, but make sure that you've got all your bases covered.
Yeah, exactly. So yeah, the big trends in the global economy and politics, as I'm sure we're about to get onto very shortly.
Well, that leads me very, smoothly onto, we've got a new government. We've had less than a month of Labour. What do you think we're likely to see with this big change in government in the UK?
So the first thing I would say on this is I don't think the UK election result is a dramatic economic change. I think the situation in the UK is quite different to the US, which I'm sure we'll talk about in a moment. In the US, there's really a gulf between the two parties, not so much in the UK. But there are a few areas which we've talked about, we've flagged up as areas where we'll see potential change. A couple of them worth mentioning. One is on the planning side of things. We know this is an area where actually both parties agreed that things needed to change. The previous government just didn't quite have the energy or the political capital to push change over the line, but we've seen it in the King's speech. What's that likely to mean in practice? Well, encouragement to increase home building in particular, and to address the fact that in the UK it's really, really expensive and really slow to build infrastructure. Just think about things like High Speed 2, that's faced 45 different legal challenges. The government wants to do something about that.
No, and that's a really good point because I think what you've sort of summarized there is there are changes that are going to impact us as individuals, but not necessarily impact the markets and our investments in the same way. Um, I personally have found that a lot of clients have been really concerned about a Labour government or what that means for them. But what you're saying to me is there's not really a huge economic, change with regards to the markets, but where it will come in is more in that sort of changes to our day-to-day life.
Yeah, I think there are also some changes which are potentially relevant to individuals as well. So we know that a big focus for Labour was the state of the public services.
Mhm.
That makes sense. It's really important. We know that the health services has not been performing well recently. We've seen a huge rise in NHS waiting lists, and that affects the economy as well. But the cost of addressing that, of, for example, granting a big pay rise to junior doctors, as Rachel Reeves announced earlier this week, that is likely to be paid for one way or another, and one way of doing that is potentially through tax. Labour's pledge not to change the taxes that bring in the most money, so VAT, national insurance, income tax, and corporation tax, and that kind of leaves the Chancellor with things like capital gains tax and inheritance tax as potential options come her first budget in October.
Yes, and with things like the increase in the need to spend on infrastructure, is there going to be an impact from underlying holdings that you have and how you're sort of allocating that asset allocation to be able to, get their companies in there or get sort of some exposure to companies that are likely to have a big boost in sort of revenue really from that?
Well, we already saw, or we already have seen some impact around the time that it became clear that Labour would win the election. You saw the house builders do well in particular.
Yeah.
Um, just more generally, we've been thinking about smaller UK companies. We know they've been unloved for a really long time. Um, if you zoom out a bit, go back to 2016 and the Brexit vote, that kind of ushered in this period of real instability in the UK, and it saw international investors for quite some time sour on UK assets generally. So the fact that Labour does have that large majority, the fact that it is doing something on some of those structural issues like planning, is potentially a positive as far as just smaller UK companies more generally are concerned. So that's something we're thinking about.
Okay, so that's quite exciting. As you say, the UK's been a little bit unloved from an investment point of view for a little while. Are there any other areas that this change in government is likely to impact from a sort of wider picture point of view from the asset allocation side of things?
Uh, Probably not too many more when it comes to the UK. I mentioned it at the start. I mean, I think our election is a different one to the US in that there's some degree of continuity as well. Like taking a leaf out of Gordon Brown's book, Rachel Reeves is starting at least with the spending plans that she's inherited. I think on the other side of the Atlantic, there are much bigger differences from a policy standpoint.
Yeah, so that leads me on to my next question. I mean, it has been a bit like a Hollywood movie, this sort of year of elections in America. We've had people resigning, we've had shootings. What, impact is that really having on the American markets or wider community?
We're getting closer to the vote. We've seen the leads in the betting markets, for example, shift around an awful lot on the back of those events that you mentioned. First of all, Joe Biden's poor performance in that first debate, then the assassination attempt on Trump, then moving right back in as Biden dropped out of the race and brought Kamala Harris much closer. In terms of policy issues, there's just such a huge gulf between the two parties on a broad range of issues. It's hard to pick out a clear trend now, but one thing I'm certainly looking at as we get closer and closer to the vote is the fact that Trump's policy offer is a particularly inflationary one. So in a few different areas, he's offering policies. Think about fiscal policy. He's promising tax cuts. He's promising to clamp down on immigration. So that tends to reduce the supply of labor. That supports inflation as well. Promising more aggressive action on trade as well. Again, that tends to be inflationary. So the risks of a second Trump presidency, particularly if the Republicans take Congress with them, are on that inflation side. And that makes us think about the risks in the US Treasury, the US government bond market, for example.
Oh, that's so interesting because we always forget, don't we, that actually, if there is a big gulf, there can be quite a big impact on that sort of market. We had obviously Liz Truss, which sort of culminated quite a lot of inflationary pressures in the UK. Is it going to be that extreme in the US, or is it going to be slightly more measured?
The key thing that I've been stressing when talking to clients about this is there's just a huge amount of uncertainty still. So when it comes to the presidential race, well, Trump's in the lead, but he's really narrowly in the lead. So the gap between him and Kamala Harris is smaller than the gap between him and Joe Biden was. If you look at the typical error in the polls, the typical gap between the polls and the final result, his lead is within that range. And then the races for Congress, for the Senate and the House, well, they're even closer. They're basically dead heats. So basically every potential election outcome is still in play, from a Republican sweep to a divided Congress to the Democrats controlling everything. It's only really in the Trump wins and the Republicans get a big win in the Senate and in the House that you potentially get those more extreme possibilities coming into play. So it's a risk. It's one we need to be aware of, particularly as the vote gets closer and the polls move in either direction. But it's by no means a certainty either.
Oh no, definitely. And you mentioned about inflation. So in the UK, inflation has, been at the target levels for the second month running. And when do you think there's going to likely be some changes in interest rates, and how do you sort of prepare for that type of scenario?
So we've already seen really the start of a global cycle in interest rate cuts. So in Canada, in the Eurozone, Sweden and Switzerland as well. We've seen the central banks in all of those places start to cut interest rates. And I mention them because really, like, those countries have faced a very similar set of shocks to the ones that we have in the UK and that the US has as well. So markets now judge that the Bank of England could start cutting interest rates at its next meeting. Which at the time of recording is just a few days away. Markets have a 60% probability of a rate cut at that meeting, and then almost 100% probability by the Bank of England September meeting. And same for the US as well. The chance of a rate cut by September, very, very high. How are we preparing for that? Well, in the UK in particular, this is one reason why we like holding UK government bonds. They tend to do well as we enter the start of rate cutting cycles. And if you look at where yields are now compared to 4 or 5 years ago, we're getting much more on that front as well. So we've got the possibility of some capital gain if interest rates continue to fall, plus that reasonable yield as well.
Interesting. So what we're sort of saying is that no one needs to panic if interest rates do start to sort of come down. That most people, if it's a 60% chance of cuts, then it sounds like the markets might be preparing themselves for the fact there might be a cut. So we don't, when I say we don't need to panic, I think the problem is there's been so much uncertainty, sort of 22, 23, that because we've had quite a good start to 24, I think a lot of people are a little bit nervous that there's going to be, a big drop off in performance.
Yeah, I mean, in terms of interest rates, you're absolutely right. The market is already anticipating some moderate cuts to interest rates. When it comes to the effect of that on markets, well, I think it always depends on why is it happening, and mostly it's for a positive reason, right? It's that the inflation shock has faded. It's good for the economy that gives central banks the license, the freedom to reduce interest rates and relieve a bit of the pressure on borrowers. That's a potentially positive thing. You talked about the outlook more generally. We can see that the global economy is still growing. The global recovery is ongoing. I would say I don't think we're in the early stages of that recovery anymore. It's not we're not experiencing very rapid growth at the moment, but still, we had the GDP data from the US last week. We've had it from Europe this week. That global recovery is still ticking over, providing support to global stocks, for example, by continuing to help profits to grow.
And I suppose the thing is, we can never be sure of, events like, Russia invading Ukraine. But what do you think the next 12 months are likely to sort of look like from a market point of view?
Well, one thing that I'm keeping a particularly close eye on is just a trend that we've seen in the past few weeks, which is a rotation, a shift in the stock market. So a big story in the stock market over the past couple of years has been the dominance of a few really big US tech companies. They've been the key drivers of performance, but we've seen a really, really different pattern just very recently. So after we had some good inflation numbers from the US, we saw smaller stocks doing much better, and actually the really big tech giants taking a bit of a pause for breath. That's something that we'd been thinking about, with a possibility that we've been considering since earlier this year. Really, the context for it is just that small stocks, having been unloved for quite a while, look really cheap compared to those bigger stocks. So that's a trend that I'll certainly be watching very closely. I think it's possible that we'll see that run a bit further, particularly if we get more progress on inflation and on the interest rate side of things.
Very interesting. So just to sort of summarize, and maybe 4 sort of key points from the conversation that we've had today, what do you think those sort of salient points to take away from people listening to us today is?
Sure. So we covered the UK first of all. On the UK, I would say I don't think that Labour coming into power is a big change from a broad economic standpoint. But Labour's commitment to public services means we probably will see some tax changes later in the year, particularly likely on the capital gains tax and maybe also on the inheritance tax side of things. again, given that the biggest taxes are frozen. We spoke a bit about the US election as well. On the US election, the key message that I've been trying to get across to clients is just one about uncertainty. It doesn't make sense to put all your eggs in one basket, to focus too much on any particular outcome, because really all the different possibilities are open. We need to be aware of the risks, and one of them is a Trump presidency and Republican sweep brings some more inflationary risks with it, but that's by no means guaranteed either. We then touched a bit on interest rates. I mentioned the fact that around the world we've seen interest rates start to fall. So the chances are that the Bank of England and the Federal Reserve in the US, they will join in with that very soon. Certainly by September, it seems highly likely that they'll join in with those rate cuts as well. And that will potentially provide a bit of support to a global recovery, which, while it's still been going on, has been just flagging a little bit recently. So I think those will be a potential positive there. And then finally, just that story on smaller stocks and the possibility that we see a bit more of that rotation away from the very big tech giants towards slightly smaller stocks to come as well.
Brilliant. So I think I would also summarize and say we don't need to panic about the fact that we have had these elections going on, that there has been some change, because ultimately a lot of the time the market's priced a lot of these situations in. So I think that's quite reassuring, and I really appreciate you sort of going through all of that with us today, Oliver. So that wraps up today's podcast. Thank you so much for listening, and a huge thank you to Oliver Jones for joining us today. If you want to listen to any future episodes, this will be shared on Integrity's YouTube channel, website, and streaming platforms in the near future. If you've got any questions for me, our advisors, or Oliver and Rathbones, please just get in touch with one of us. And if there's anything you want to talk about in a future episode, please again just let us know what you'd like to hear. Thanks again for joining us.